Welcome to another market update. It's Sunday, August 21st, after the market closed on Friday the 19th. Just checking in to see, we're going to look at, as we do every week, the long-term trend, medium-term trend, and what's going on, what we think is happening in the short-term trend. So, just in response to a couple of questions I've had during the week, just to clarify the difference between, where I think things are long term and short term, etc. Longer term, the market is, as it always has done, the Federal Reserve and all the central banks cannot destroy the business cycle. There will be bull markets and there will be bear markets, and that's just the way it goes. They've tried to postpone that, I would argue, because of a presidential election coming up. And all they've done is made it worse in the end. So this market will go down. Markets always go down. And when it happens, it's going to be even worse for all the interfering. But we're not there yet. But look at the business. This is what I'm talking about by the business cycle. Bull and bear. This is going from 1998. Bull and bear. Bull and bear. And this monster that's been created here, really, you can see in relation to 2007, the 2008 crash that followed that bull market. I mean, just look where it is right now. I mean, it's terrifying in its size, and also in terms of the artificiality that has raised this monster. This is the bubble caused by governments. This is easy money, low interest rates, and governments buying their own debts. It totally into uncharted territory. And what's happened now is, because of low interest rates, that means bonds aren't paying any money at all, and that's what your pension fund relies on, is they buy bonds usually, and the yield from these bonds is what they're looking to get to pay retirees and people hoping to retire, and that's just not there because of government interference. And as a result, the pension funds have been squeezed to look elsewhere for returns, and that's put them into equity markets, the stock market, as well as other way more risky things that they have no business being in, and this whole thing will end in tears. So that's where I stand in the longer term. I'm talking 6 months to a year ahead, and I don't see that signal yet. One of the things I'm doing through the 99 Club membership is we're looking at pinpointing an exact time of when to short that market and profit from that drop when it happens, because it will be momentous. So there's the let's look on the 5-year chart. There it is. This is the S&P 500, which is a kind of benchmark stock index. If I look at all of the American stock exchanges, they're all in one. It doesn't look quite as good as that. We can see that although the S&P 500 broke out to a new high, the kind of overall stock market hasn't as yet. It's definitely recovering, but it's definitely got a stretched look to it, and it may even be starting to roll over in the short term. But with the election just a couple of months away, there's no way the Federal Reserve is going to allow any trouble to happen that's in their control anyway, barring a terrorist event or something. Anything that they can control to keep this party going just another couple of months, they will do. And that, to a certain extent, is underpinning the sort of short-term picture as being a little bit bullish. But let's zoom in on kind of daily short-term chart, the S&P 500. And we've moved, I said last week, when the short-term trend of this thing is up, and it's moved up from here to here, and it's maintaining that shelf there along 2175. I would see 2175 as being the kind of floor in this. If it breaks below that, then we could see a shorter term correction. Overall, this market, even in the short term, is a little bit stretched now. It's not to say it can't go higher, but it's showing signs of there might be a very brief and muted correction coming up. So that'll be the line to watch then, 2175. It may correct down a little bit, which is probably what they want to do, and then have one last surge before the election, which, by the way, is on November the 10th. So shorter term, I think it's just hanging in there, might be pushing up a little bit more, but don't be surprised to see it was a healthy correction. So I wouldn't be looking to add any new positions, but ride what profits, maybe take some profits, because at the end of the day, there's the bigger picture is that this isn't exactly a cheap market. Things are getting expensive, but they could get more expensive. Like I said, the pension funds are pouring money into this, and we could still see a much bigger blow off before the market turns. We're not at that point yet. So shorter term, the trend is definitely still up, but don't be surprised to see a bit of a pullback along the way. And medium to longer term, though, still very bearish. As this market must eventually take its turn in the down cycle, but we're not there yet. Speak to you next week.